Question, we'll walk through the accounting for warrants. Snowboard Capital Limited issued 500 $1,000 bonds at 103. Each bond was issued with 10 detachable stock warrants. After issuance, similar bonds were sold at 97, and the warrants had a fair value of 250. The first thing we're asked to do is record the issuance of the bonds and warrants, assuming that Snowboard Capital follows IFRS. And then after, we're asked to assume that they are going to follow ASPI. So let's start with recording this transaction, assuming that we're following IFRS. So we've got IFRS. So how are we going to record this using IFRS? Well, IFRS requires us to value the debt first. So we're told that we purchased 500 1,000 bonds at 103, but this is the combined instrument. This is each bond was issued with 10 warrants. So the 103 includes the bonds and the warrants. What we want to know is how much is just the bonds without the warrants, so we can bifurcate the accounting for the debt from the equity. Then it says, after issuance, similar bonds were sold at 97, and the warrants had a fair value of 250. So in this sense, we're given enough information to value the debt and the warrants. So which piece are we going to choose for IFRS? Well, again, IFRS requires the debt to be valued first. So we know that the bonds are going to be sold at 97. So the value of our bonds is going to be 500 bonds, 500 $1,000 bonds at 97. So let's start with that. So we're going to have 500 times $1,000 bonds. That's the face. This is the face times 97. And that is going to give us 485,000. So this is the value of the debt. And then IFRS says that then we're going to value the remainder towards the remainder of what we paid, then will be attributed to the equity. So how much did we pay? Well, we paid for the combined warrant, or for the combined instruments, the debt and the warrant, we paid 103, so 500. So we paid 500 times 1,000, which is the face, times 103. So we paid, next is going to give us 515,000 equals what we paid. So therefore, the difference between 515 and 485, which is going to be 30,000. Just ignore the sign here. I'm just taking the difference between the two numbers. It doesn't matter that I've got the bigger one at the bottom. I'm just figuring out what the warrants are worth. Then this is going to equal the value for the warrants. So you can see how IFRS requires us to value the debt first. Then we're going to figure out how much we paid, and the remaining value is going to be attributed to the warrants. So the journal entry to record this is going to be debit cash, because we're actually selling this item. So we're the combined item. So we're going to sell, so we're going to raise 515,000. Then we're going to have credit bonds payable, because we owe this back to the bondholders or the investors. And it's going to be at 485,000. And we're going to go credit contributed surplus. Warrants. And this is going to be our 30,000. Okay, so that's our entry under IFRS. Let's take a look above and see what the next part of this question was. So B said, assuming that Snowboard Capital follows ASPI, discuss the two options available to record the issuance of the bonds and the warrants and prepare a journal entry for each option. So like we said, IFRS required us to value the debt first. So we knew what we needed to do there. Now, ASPI allows us to have two policy choices. And the question is asking us to discuss the two policy choices and prepare the journal entry for each option. So let's take a look at that. So we've got ASPI. Oops, let's go down here, ASPI. Okay, so we've got, there's two options. So one option is you can measure whatever instrument is most easy to measure first, and then apply the residual to the other component. So unlike IFRS, where IFRS says the debt has to be the first component, ASPI says whatever's easiest you can measure first, and then allocate the difference to the other. So you could have the exact same journal entry under IFRS. Under ASPI, if the preparer decided to value the debt first because we had the information for that. But we also had the information to measure the warrant. When we looked up at the question here, we were told that the bonds were at 97, and then we were told that the warrants had a fair value of 250. So it looks like we had the information to value the warrants as well. So let's take a look at that. So if we go, so let's do the math down here. So if we go, so the value of the warrants is going to be 500 times, let's see, how many of these do we have? 1,000 bonds, each was issued with 10 warrants. Okay, so we've got, let's see what we have here, hang on, 500 bonds, and each was issued with 10 warrants. So 500 bonds times 10 warrants times 250 for each warrant value. This is going to give us $12,500. So therefore, our journal entry under ASPI would be the cash that we paid is the same. So we know this number that we calculated above is the same. So we're going to go debit cash, 515,000. We're going to go credit, contributed surplus, warrants. And this is going to be our 12,500 that we calculated right here. This is the warrant. And then the remainder is going to go to the bond payable. And so the balancing entry, so 515 minus 12,500 means that our bond payable is going to be recorded at 502,500. So that's one policy choice under ASPI. Another policy choice that ASPI allows is to measure the equity at 0. So this is going to be value the warrant first. And the other thing that ASPI allows us to do is value equity at 0. So ASPI would also allow us just to simply say debit cash, 515,000. That number never changes because that's just a simple amount that came out of our bank account. You can't manipulate that in any of the entries. Credit bond payable for 515,000. So in this case, ASPI is taking the policy choice to value the equity at 0, meaning that whatever we paid, we just attribute it all to the bond payable. Keeps it simple, but it isn't necessarily keeping our financial statements the most accurate, although it is allowed under ASPI. And the other option under ASPI is to value the warrant first. So ASPI allows us to value whichever of the two instruments is most easily measurable. In this case, we had enough information to value the debt and the warrant. So we already valued the debt under IFRS first, which we're required to do always under IFRS. ASPI could have done that exact same thing, or it could have also valued the warrant first and put the remainder to the debt. Or ASPI could decide to value the equity at 0 and therefore put the entire amount that was paid to the bond payable. All right, let's take a look back at the question. So we've done one. and we've done 2. So we finished part A. So now let's look at part 2. Assume that the instruments are convertible bonds and they have now been converted. Assume that Snowboard Capital follows ASPI and that all of the proceeds were allocated to the debt component upon initial recognition. At the time of conversion, the unamortized bond premium was $10,000 and the common shares had a fair value of $50 per share. Record the conversion using the book value method. What's the book value method? Well, the book value method means that we are not going to have a gain or loss on the settlement of the debt. Whatever was paid, the difference is simply going to be recorded in the common share account. So let's record this entry. So it's telling us exactly what journal entry we're going to be working with here. So it says Snowboard Capital assume that they followed ASPI and that the debt and that all proceeds were allocated to the debt component upon initial recognition, meaning that we're looking at this scenario here where we, under ASPI, there was an accounting policy choice to value the equity at 0. So now what's happening is that these warrants are going to be converted. So we're told that the unamortized premium was $10,000. So here you can see that we have a premium at $15,000 because this is a $500,000 bond, or the bond at par would be $500,000, I should say. So when we record, so this is going to be part 2, bond conversion, bond conversion, ASPI. So we're going to have to say, so what would the bond be valued at then on our statement of financial position? Because we obviously need to remove the bond payable when it's converted from our statement of financial position. And we're told that there was an unamortized premium of $10,000, meaning that this bond must be at $510,000, the premium, so $10,000 higher than $500,000. And the remainder is simply going to go into our common share account, because now that it's exercised, we're going to be issuing these common shares and the exact amount goes in there. So there's no gain or loss on the settlement of the debt. The book value method says it simply washes through common shares, the equity account. Okay, so we've got this one. Part 3, now assume that the instruments are convertible bonds and that they have now been converted. Assume that Snowboard Capital follows IFRS and recorded the issuance of the bonds and conversion rights accordingly. We know that that means that we valued the debt first. On a date when the bonds had a carrying value of $489,100, Snowboard Capital paid $14,000 to the bondholders to induce early conversion. Record the conversion using the book value method. Normally, the book value method means that there's no gain or loss on the settlement of debt. However, when there's an inducement to convert, the inducement alone will generate a loss. So let's take a look at this journal entry. So we know that we're working with this journal entry here because we're working with IFRS. So let's see what we've got. So we know that we need to clear out this entry. So let's go down here. This is going to be part 3, bond conversion IFRS, bond conversion, and inducement IFRS. Okay, so we know that we need to clear out the bond payable. So we know we need to debit the bond payable. And we know we need to debit contributed surplus, because we need to clear out these accounts that we had previously recorded in our earlier entry. So the bond payable, we're told that the bond payable, go up here, the bond payable has a carrying value of $489,100, meaning that that's what the bond payable is recorded at on our statement of financial position. So we know we're going to clear out $489,100 here. And contributed surplus, we had put 30,000 into that in our previous entry. So now we're simply debiting it to clear it out. As this bond is converted, we need to make sure that we've got the liability and the contributed surplus side cleared out. And then we're going to have to record the conversion, because the conversion is going to generate a loss. Actually, we'll deal with that in a second. Next, we're going to deal with, actually, no, let's look at the conversion. So we're going to have, how are we going to record the conversion? Well, the conversion is going to be debit loss on redemption of bonds. And the book value method means we wouldn't have a loss on redemption. This loss on redemption is simply the inducement of the 14,000 that we were told in the question. And we're also going to have to pay out cash of 14,000 because we are inducing the bondholders to convert. We've decided we want this to happen right now. We'll give them an extra $14,000. That's going to generate a loss in our income statement. And we're also going to have to pay out the 14,000. And then the remainder is going to go to the common share account, because we are issuing common shares after all. That's the whole point of converting. And the common share account is simply going to be the sum of these two items. So it's going to be the sum of the bond payable carrying value and contributed surplus, which is going to give us 519,100 as our journal entry. So hopefully that makes sense. We have decided to induce the bondholders to convert their bonds. That means that we no longer have the bond payable or the associated contributed surplus account. Rather, we are enticing them to execute their convertible debt, and we're going to issue them the shares. And in order to make that happen, we've agreed to pay them $14,000, which is going to create a loss for us for the $14,000, and we have to pay out the additional $14,000 in cash. All right, let's scroll back up. Okay, so now we've done part 3. Part 4. Now assume that the instruments are convertible bonds and that they have now been converted. Assume that Snowboard Capital follows ASPI and valued the debt component first, applying the residual to the equity component. On a date when the bonds had a carrying value of $489 and a fair value of $449,370, Snowboard Capital paid $530,000 in cash to the bondholders to retire the bonds early. Record the retirement using the book value method. Okay. So ASPI is a little bit more complex in terms of inducements. Part 4, ASPI, bond conversion, an inducement. Okay, so we know that we are going to need to clear out the bonds payable and the contributed surplus account. So let's start with that. Bonds payable and debit contributed surplus. Okay, so we know it's contributed surplus. We had 30,000 in there. That's the same always. Let's take a look at what the carrying value of the bonds were. Scrolling way back up. So the bonds had a carrying value of $489,100. So that's what we're going to remove. Whatever they were carried at on our statement of financial position is what we need to debit them for. So there's our $489,100. Now we are going to have to record the inducement. So we cleared these things out at 7:30. So let's figure out what the loss on the redemption of the bonds was here, because the way that ASPI works is that we need to allocate the amount that was paid, which is going to be this 530. So let's just record that actually. So we've got cash. We're told in the question that we paid out 530,000 to make this all happen. So now we know that there's going to be a loss on the redemption of the bonds, but ASPI requires us to allocate that loss between the bonds and the equity component. So let's take a look at what the loss on the bonds is going to be. So loss on bond redemption make sure I leave enough room to make the journal entry here. It's going to be the fair value of the bond minus the carrying value. So the fair value of the bond, we're told in the question, was we were given this additional information that normally we wouldn't need, 492,370, minus the carrying value, which we know right here, 489,100. So let's just back up for a second. So if we scroll up to the question, okay, so we're told, see how it says the bonds had a carrying value of 489,100 and a fair value of 492,370. Normally we wouldn't require the fair value of 492,370, but we require it for ASPI to allocate the inducement. So 492,370, which is the fair value minus the carrying value of 489,100, is going to give us $3,270. That means that we actually exercise this debt for $3,270 less than the fair value, meaning that there needs to be a loss on the redemption of the debt. Loss on bond redemption, which is going to be $3,270 here. And we actually paid out, so the amount that we actually paid was, well, so we received 530,000 and we took out a carrying value of 489,100 and we took out contributed surplus of 30,000. That is going to leave us with $7,630, and this is going to go through retained earnings. So that's our journal entry here to record the bond conversion and inducement using ASPI. So let's take a look at what we did here. So we cleared out the bond payable. So this is the carrying value. So we wiped that off our statement of financial position. We wiped out the contributed surplus because now that this convertible debt is going to be exercised, we don't need those amounts anymore. We know that we paid out 530,000 in cash to the bondholders to entice them to convert and redeem and pay off the debt. And the difference then, so then we figured out what the loss on the bond redemption was, which was the difference between the fair value of the debt and the carrying value. So we cleared out the debt that was worth 492. We cleared it out at 489. That means we lost 3,270. And we received 530,000, even though we had a bond on our statement of financial position at 489,100, and we had contributed surplus at, and we had contributed surplus of $30,000, and that means that we had to debit our retained earnings by $7,630. Hope that makes sense. This is a pretty complicated question as far as warrants go. So if you can get through this question and follow through all the logic, you will be in good shape for most exam questions.